If you want to build your career in finance and you want to grow, then you have to learn corporate finance, because corporate finance is the important role and vital role in the finance. That's why we have started a series in corporate finance, and this is our third video. If you haven't watched our previous videos, so go and watch it. And today's video is margin and acquisition. Today in this session, we will discuss about the following points. The first one, steps of acquisition process. Second, acquisition valuation process. Third, due diligence. Fourth, financing, merger and acquisition. And last but not least, types of buyers. Steps of acquisition process. There is total 8 steps. The first step is acquisition strategy. So in this process, you have to build an object, what type of company you are looking for, criteria like industry size, geography, growth, etc. The second process is searching for the target. Identify potential target companies that meet the acquisition criteria. Prepare a short list of suitable targets, analyze and distribute. Third, acquisition planning. In this process, you have to develop overall acquisition strategy. Decide whether the acquisition will be friendly or hostile. Determine the proposed transaction structure and consider potential synergies and integration issues. Fourth, acquisition valuation. Here, you have to value that business, that company. You have to, in previous video, we already discussed about DCF model, comparable company analysis, precedent transaction. These are the method to value a business. So you have to use in this process. Fifth, due diligence. Conduct a detailed investigation of the target before finalizing the deal. Example like financial statement, tax matter, legal issue, contract, employees. Like many, sometimes there is a hidden liabilities, risks. So you have to identify and investigate detailing. Detailed investigation is required in this process. Then sixth, negotiation and purchase and sale contract. You have to negotiate with the company for before the acquiring. And seventh, financing. So sometimes company purchase means acquire a business through debt, through equity, through cash. There is lot of option before acquiring a company. So in this process, we will learn this. And the fourth and the eighth is implementation. Regularity and shareholder approval you are required, complete transaction, transfer ownership, and many things. So these are the total 8 process. We have to fulfill all the process to acquire a business. Now we move on to acquisition valuation process. So the first step is to value the target as standalone. In the previous video, we already discussed the 3 model for the valuation of any business. The first one is DCF model, second comparable company analysis, and the third precedent transactions. These are the 3 methods to value a business. So this is the first step of the acquisition valuation process. So the next step of acquisition valuation process is value synergies. So what is synergies? Synergies is the extra value that is created after the acquisition. There is total 3 synergies, which is hard synergies, soft synergies, and financial synergies. So what is hard synergies? Hard synergy are measurable and relatable certain cost or revenue benefit that can be directly quantified, just like eliminating duplicate department, reducing employee costs, reducing distribution costs. These are called hard synergies. So next we'll move on to soft synergies. It's potential benefit that are more difficult to quantify and are less certain, like better management, improve brand reputation, improve innovation, knowledge and skill sharing. These are called soft synergies. And the third, financial synergies. It arises when the combined company achieve financial benefit that our company could not achieve separately, like lower cost of borrowing, lower cost of capital, tax benefit, improved debt capacity, all financial related material are come under these financial synergies. Okay, so the second step is the value synergies. So next move on to our third step, integration cost. So what is integration cost? It is a one time or short time expenses incurred during combination of the two company. It is only one time cost like IT integration cost, employee restructuring, rebranding, training. These are the costs which occur when the two company merge or acquire. So it is a one time cost. That's called integration cost. So after combining all these three steps, we are getting the maximum acquisition value. So the maximum acquisition value, there is a formula. The first is the standalone value, which is measured by the DCF model, comparable company preceding transaction. After adding with the total synergies, the extra value we're getting from that past value. So hard synergies, soft synergies, and financial synergies, all these synergies we are adding with the value of the standalone company. Then deducting implementation cost, the extra cost, one-time expenses. These are the costs which is coming from after acquiring a business. So we are deducting this from the total value. After all these three, we are getting the maximum value after the acquisition. This is the new valuation of to merge company, the total company. Okay. After the total valuation process completed, now we move on to the due diligence. So, what is due diligence? Due diligence is the detailed investigation of the target company before completing an acquisition. What type of investing we are doing? Financial, legal, tax, commercial, operation, HR, IT, and tech. All these department we are going thoroughly and we are investigating before we acquiring that company. Okay, that's called due diligence. Now come to the main part of the all total process, the main part, which is financing M&A. After completing all the steps, after completing valuation, after completing investigation, after satisfy everything, we have to finance, we have to buy that company. So how will I buy that company? So there is total three. The first, how the acquisition will be financed. So the first one is senior debt. We will acquire that company through senior debt. Second, subordinate debt. The third is equity with our own pocket money. So these are the three finance steps to use for acquisition: the senior debt, subordinate debt, and the third equity. So now the last part of this video: who are the buyers for the M&A? Who will buy these companies? So there is total two buyers. The first one is strategic buyers. Who are the strategic buyers? They think that after this acquisition, is it helpful for my business? It involves identifying and delivering operating synergies like hard synergies and soft synergies. Example, Microsoft buys LinkedIn to strengthen and expand its existing business. They think after that acquisition, will it my company improve or not? These are called strategic buyers. Second, financial buyers. Who are financial buyers? They only think how does return can I make from this investment, like private equity, leverage for maximum return. Okay, they only invest and after that business going profitable and after the value increase, they sell that business. So they just take the return from this their investment and that's all. These are called financial buyers. So I hope this video is completely useful for you. If you like this video, then please subscribe my channel and wait for the next part. So, signing off.